Okay, CFA Level 1 Program Curriculum Reading 8 Statistical Concepts and Market Returns Learning Outcomes. Distinguish between descriptive statistics and inferential statistics, between a population and a sample, and among the types of measurement scales. Define a parameter, a sample statistics, and a frequency distribution. Calculate and interpret relative frequencies and cumulative relative frequencies. Give a frequency distribution. Describe the properties of a data set presented as a histogram or a frequency polygon. Calculate and interpret measures of central tendency, including the population mean, sample mean, arithmetic mean, weighted average or mean, geometric mean, harmonic mean, median, and mode. Calculate and interpret quartiles, deciles, and percentiles. Calculate and interpret a range and a mean of absolute deviation and a variance of standard deviation of a population and a sample. Calculate and interpret the population of observations falling within a specific number of standard deviation of the mean using the Chebyshev's inequality. Calculate and interpret the coefficient of variation for the Sharpe ratio. Explain skewedness and meaning of positive or negative skewed return distributions. Learning outcomes. The candidate, furthermore, K, describe the relative locations of the means, medians, and mode for a unimodal, non-symmetrical distribution, and explain measures of simple skewedness and kurtosis. Compare the use of arithmetic and geometric means when analyzing investment returns. Introduction. Statistical methods provide a powerful set of tools for analyzing data and drawing conclusions from them. Whether we are analyzing asset returns, earning growth rates, commodity prices, or any other financial data, statistical tools help us quantify and communicate the data's important features. This reading presents the basics of distributing and analyzing data, the branch of statistics known as descriptive statistics. The reading supplies a set of useful concepts and tools illustrated in a variety of investment contexts. One theme of our presentation reflected in the reading's title is the demonstration of the statistical methods that allows us to summarize return distributions. We explore 4 properties for return distributions, where the returns are centered tendency, how far returns are dispersed from the center. That is what we call the dispersion. Whether the distribution of returns is symmetrically shaped or lopsided, that is the skewedness, and whether extreme outcomes are likely to occur, that is the kurtosis. Okay, so these are some vocabulary that would be helpful to know. So, for example, standard deviation was calculate the dispersion, and outliers will be related to kurtosis. The same concepts are generally applicable to the distribution of other types of data too. The reading is organized as follows after defining some basic concepts in Section 2 and Section 3. In Section 3 and 4, we discussed the presentation of data. Section 3 describes the organization of data in table format. Section 4 describes the graphic presentation of data. We then turn to the quantitative description of how data are distributed. Section 5 focuses on measures that quantify where data are centered or measures of central tendency. Section 6 presents other measures that describe the location of data. Section 7 presents measures that quantifies the degree to which data are dispersed. Section 8 and 9 describes additional measures that provide a more accurate picture of data. Section 10 provides the investment applications of concepts introduced in Section 5. Section 2, some fundamental concepts. Before starting the study of statistics with this reading, it may be helpful to examine a picture of overall field. In the following, we briefly describe a scope of statistics and its branch of study. We explain the concepts of population and sample. Data comes in a variety of types, affecting the ways they could be measured and the appropriate statistical models for analyzing them. We conclude by discussing the basic types of data measurement. The nature of statistics. The term statistics can have two broad meanings, one referring to data and the other to the method. A company's average earnings per share, or the EPS, for the last 20 quarters or 5 years, usually, or its average return in the past 10 years. What? A quarter is a fourth of a year. So 3 months. So 20 quarters would be 20 multiply. Well, that doesn't make any sense. Yeah, who cares? We may also analyze historical EPS for forecast features EPS, or use the company's past returns to infer the risk. The totality of methods we employ to collect and analyze data is called statistics. Statistical method include descriptive statistics and statistical inference or inferential statistics, or descriptive statistics is the study of how data can be summarized effectively to describe the important aspects of large data sets by consolidating a mass of numerical details. Descriptive statistics turn data into information. Statistical inference involves making forecasts, estimates, or judgments about a larger group from the smaller group actually observed. The foundation of statistical inference is probability theory. Both statistical inference and probability theory will be discussed in later readings. Our focus is the reading is solely on descriptive statistics. A population and samples. Throughout the study of statistics, we make a critical distinction between a population and a sample. In this section, we explain these two terms as well as the related terms, a parameter and sample statistics. A definition of population. A population is defined as a member of a specified group. Any descriptive measures of a population characteristic is called a parameter. Although a population can have many parameters, investment analysts are usually concerned with only a few, such as the mean value, the range of investment returns, and the variance. Even if it is possible to observe all the members of a population, it is often too expensive in terms of time or money to attempt to do so. For example, if a population of all the telecommunication customers worldwide and an analyst is interested in purchasing plans, she would find it too costly to observe the entire population. The analyst can address this situation by taking a sample of the population. Definition of a sample is a subset of a population. In taking a sample, the analyst hopes it is characteristic of the population. The field of statistics known as sampling deals with taking samples in appropriate ways to achieve the objectives of representing the population well. Later reading addresses the details of sampling. Earlier, we mentioned statistics in the sense of referring to data, just as a parameter is a descriptive measure of a population characteristics. Sample statistics, or statistics for short, is a descriptive measure of a sample characteristics. Characteristic definition of sample statistics. A sample statistics or statistic is a quantity computed after or used to describe a sample. We devote much of this reading to explaining and illustrating the use of statistics in this sense. The concept is critical also in the statistical inference, which addresses such problems as estimating a known population parameter using a sample statistic. 2.3 measurement scales to choose the appropriate statistical methods for summarizing and analyzing data. We need to distinguish between amount among different measurement scales or levels of measurement. All data measurements are taken on one of four major scales: nominal, ordinal, interval, or ratio. Nominal scales represents the weakest level of measurement. They categorize data but not rank them, in which assigned integers to mutual funds that allow different investment strategies. The number 1 might refer to small cap venture funds nominal, and number 2 large cap venture funds, and so on. For each possible style, this nominal scale categorizes funds according to their style but does not rank them. Ordinal scales reflects a stronger level of measurement. Ordinal scales sort data into categories that are ordered with respect to some characteristic. For example, the Morningstar and Standards and Poor's stars ratings for mutual fund represents the ordinal scale, in which 1 star represents a group of funds judged to have relatively the worst performance, with 2, 3, 4, and 5 stars representing groups with increasingly better performance as evaluated by those services. An ordinal scale may also involve numbers to identify categories. For example, in ranking balanced mutual funds based on their 5-year cumulative returns, we might assign the number 1 to the top 10% of the funds, and so on, so that the number 10 represents the bottom 10% of the fund. The ordinal scale is stronger than the nominal scale because it ranks the fund. It reveals that a fund ranked 1 performs better than a fund rank 2, and the scale tells us nothing, however, about the difference in performance between funds rank 1 and 2 compared to the difference in the funds rank 3, 4, 9, and 10. Interval scales provide not only ranking but also assurance that the differences between the scale value are equal. As a result, scale values could be added and subtracted meaningfully. The Celsius and Fahrenheit scales are interval measurement scales. The difference in temperature between 10 degrees Celsius and 11 degrees Celsius is the same amount as the difference between 40 degrees Celsius and 41 degrees Celsius. We could then state we could state accurately that 12 degrees Celsius equals 9 plus 3 degrees Celsius. Now, because the difference between each two integer or integer numbers is equal to each other regardless of the coefficient quantities. For example, nevertheless, the 0 point of the interval scale does not reflect complete absence of what is being measured. It is not a true 0 point or natural 0 degrees Celsius corresponds to the freezing point of water, not the absence of temperature. As a consequence, the absence of true 0 point, we cannot meaningfully form ratios of interval scales. As an example, 50 degrees Celsius, although 5 times as large as the number 10 degrees, does not represent 5 times as much temperature. Also, questionnaires scales are often treated as an interval scale if an investor is asked to rank his risk aversion on a scale from 1, extremely risk adverse, to 7, extremely risk loving. The difference between a response of 1 and a response of 2 is sometimes assumed to represent the same difference in risk aversion as the difference between responses of 6 and responses of 7. When that assumption can be justified, the data are measured as an interval scale. Ratio scale represents the strongest level of measurement, and they have all the characteristics of interval measurement scales as well as true 0 points as the origin. With ratio scales, we can meaningfully compute ratios as well as meaningfully add and subtract amounts within the scale. As a result, we could apply the widest range of statistical tools to data measured on ratio scale. Why does ratio sounds like race as an ethnicity, but ratio is like ratio instead of racial? Okay, so ratio scales, rates of returns are measured on a ratio scale as is money. If we have twice as much money, then we have twice the purchasing power. Note that the scale has a natural 0, meaning no money. Now that we have addressed the important preliminaries, we could discuss some we could discuss summarizing and describing data. Example 1, identifying scales of measurement. State the scales of measurement for each of the following: credit rating for bond issues, cash dividend per share, hedge fund classification types, and bond maturity in years. Credit ratings are measured on the ordinary scale, a rate placed on a bond issued in category. The categories are ordered order with respect to the expected probability of its default, but the difference in the expected probability of default between A minus and A plus, for example, is not necessarily equal between B minus and B plus. In other words, letter credit ratings is not measured by an interval scale. Secondly, we have cash dividend pay or per share. Cash dividend per share are measured by a ratio scale for the variable. 0 represents the complete absence of dividends and is a true 0 point. So number 3 is the hedge funds classification type. Hedge funds classification types are measured on a nominal scale. Each type groups together hedge funds with similar investment strategies. In contrast to credit rating for bonds, however, hedge fund classification schemes do not involve a ranking. Thus, such classification schemes are not measured on an ordinal scale. Number 5, bond maturity in years. Bond maturity is measured on a ratio measured on a ratio scale. So I do hope this video and this reading has been helpful, at least in some ways, and I do hope to see you guys in the next video. We'll be continue chapter 8 of reading 8 of CFA level 1 program curriculum. So I do hope my videos are helpful, and I hope to see you guys in the next one. Now, take it easy. Goodbye. Continued reading of the CFA Level 1 program curriculum. Now at CFA Level 1, reading 8, Part 4, the graphic representation of data. A graphical display of data allows us to visualize important characteristics quickly. For example, we may see that the distribution is symmetrically shaped, and this finding may influence which probability distribution we use to describe the data. In this section, we discuss the histogram, the frequency polygon, the cumulative frequency distribution as methods for displaying data graphically. We construct all of these graphic presentations with the information contained in the frequency distribution of the S&P 500 shown in either Table 3 or Table 4. The histogram. Histogram is a graphical equivalent of a frequency distribution. Definition of histogram. A histogram is a bar chart of data that have been grouped into a frequency distribution. The advantage of a visual display is that we can see quickly where most of the observations lie. To see how a historical histogram is constructed, look at the return intervals of between 18 and 20%. In Table 3, the intervals has an absolute frequency of 6. Therefore, we erect rectangles with the height of 6 or over the return interval on the horizon axis. Continuing with this process for all other return intervals with a new histogram. Figure 1 presents the histogram of the annual total return series of the S&P 500 from 1926 to 2012. Okay, so between negative 44 and negative 42, we have 1. This is the most common. The most common is negative 12 to positive 10. These are also really common as well. Okay. In the histogram of Figure 1, the height of each bar represents the absolute frequency of each return intervals. The return interval of negative 10 to negative 8 has a frequency of 7 and is represented by the tallest in the histogram because there are no gaps between the interval limits. There are no gaps between the bars of the histogram. Many of the return intervals have zero frequencies. Therefore, they have no height in the histogram. Figure 2 presents the histogram for the distribution of monthly returns on the S&P 500, somewhat more symmetrically shaped than the histogram of annual returns shown in Figure 1. The histogram also appears more bell-shaped than the distribution of the annual rate. Okay, so it's more bell-shaped. It has peaks around the -2 to 0% rate. Okay, and then it sort of goes down. 4.2, frequency polygons and the cumulative frequency distributions. Two other graphical tools for displaying data are the frequency polygon with the cumulative frequency distribution. To construct a frequency polygon, we plot the midpoint of each interval on the x-axis and the absolute frequency for the interval on the y-axis. We then connect neighboring points with a straight line. Figure 3 shows the frequency polygon for the 1,044 monthly returns of the S&P 500 from January 1926 to December 2012. So yeah, this is the frequency of it occurring, and here's the percentage. The frequency of a negative 17% occurring is this much. The frequency of a 3% occurring is this much. Okay, so that just shows the polygon of the frequency polygon of the S&P monthly total returns. In Figure 3, we have replaced the bar with a histogram. So histogram is, instead of bars, is a line representing the connected points, with the points connected by straight lines. For example, the return interval of 0 to 2% has an absolute frequency of 220. In the frequency polygon, we plot the return individual midpoint of 1% and a frequency of 220. We plot all the other points in a similar way. This forms a visual display adds a degree of continuity to the representation of the distribution. Another form of line graph is the cumulative frequency distribution. Such a graph can plot either the cumulative absolute or cumulative relative frequency against the upper interval limits. The cumulative frequency distribution allows us to see how many or what percent of the observation to lie between a certain value. To construct the cumulative frequency distribution, we graph the returns in the fourth or fifth column of Table 4 against the upper limit of each return interval. Figure 4 presents a graph of the cumulative absolute distribution for monthly returns on the S&P 500. Notice that the cumulative distribution tends to flatten out when returns are extremely negative or extremely positive. The steep slope in the middle of Figure 4 reflects the fact that most of the observations lie in the neighborhood of -2 to 6%. So as the percentage go on, they are cumulative, so they add on top of each other. So the cumulative absolute frequency distribution of S&P 500 monthly total returns of January 1926 to December 2012. So if you know basic math, you will know this. Basic modeling, basic statistics, you'll be able to understand this without any problems. We could further examine the relationship between the relative frequency of the cumulative relative frequency by looking at the two return interval produced in Table 7. The first return interval, 0% to 2%, has a cumulative relative frequency of 59%. The next return interval, 2% to 4%, has a cumulative relative frequency of 75.57%. The change in the cumulative relative frequency as we move from one interval to the next is the next interval's relative frequency. For instance, as we go from the first return interval of 0% to 2% to the next return interval of 2% to 4%, the change in the cumulative relative frequency is 75.57%, subtracted by 59%. Which is 16.57%, which is the values in the table have been rounded to the second decimal place. The fact that the slope is steep indicates that these frequencies are large. As you could see in the graph of the cumulative distribution, the slope of the curve changes as we move from the first return interval to the last. A fairly small slope for the cumulative distribution for the first few return intervals tells us that these return intervals do not contain many observations, you could go back to the frequency distribution table 4 and verify that the cumulative absolute frequency is only 25 observations. The cumulative relative frequency is 2.39% up to the 10th return interval, or negative or between negative 12 and negative 10%. In essence, the slope of the cumulative absolute distribution of any particular interval is proportional to the number of observations in their interval. Table 7 selected class frequencies for the S&P 500 monthly returns. A return interval of this has of 2 to 4, for example, has an absolute frequency of this much, has a relative frequency of this many percent, and the cumulative frequency of this. Okay, so that should not be too hard. All right, CFA Level 1 Program Curriculum, Reading 8, Part 5, Measures of Central Tendency. Part 5, Reading 8, CFA Level 1, Measures of Central Tendency. So far, we have discussed methods we could use to organize the present data so that they are more understandable. The frequency distribution of an asset's classes returns series, for example, reveals the nature of the risk that investors may encounter in a particular asset class. As an illustration, the histogram of the annual return on the S&P 500 clearly shows the large positive and negative annual returns are common. Although frequency distributions and histogram provides a convenient way to summarize a series of observations, these methods are just a first step toward describing characteristics of data. Our focus is on measures of central tendency, and other measures of location and location parameters. A measure of central tendency specifies where the data is centered. Measures of central tendencies are probably more widely used in other statistical measures because they can be computed and applied easily. Measures of location includes not only measures of central tendency, but other measures that illustrates the location or distribution of data. In the following subsections, we explain the common measures of central tendency, the arithmetic means, the median, the mode, the weighted mean, and the geometric mean. We also explain the usefulness of measures of these locations, including quartiles, quintiles, and declines and percentiles. So if you have done statistics and math, these are all high school math stuff. As respectable professional adults, you should all be able to know most of these. So 5.1, the arithmetic mean. Analysts and portfolio managers often want one number to describe a representative possible outcome of an investment decision. The arithmetic mean is by far the most frequently used measure of the middle or center of data. Definition of arithmetic mean. The arithmetic mean is the sum of the observation divided by the number of observation. So the average, okay? We could compute the arithmetic mean by both population and sample, known as the population mean and the sample mean, respectively. The population mean is the arithmetic mean computed by for a population. If we can define a population adequately, then we could calculate the population mean as the arithmetic mean of all the observations or values in the population. For example, analysts examine the fiscal 2013 year-over-year growth in same-store sales of major U.S. wholesale clubs. Might define the population of interest to include only 3 companies: BJ's Wholesale Club, a private company since 2011, Costco Wholesale Corporation, and Sam's Club, part of the Walmart stores. As another example, if a portfolio manager investment universe, the set of securities he or she may choose from. The Nikkei 220 index is the relevant population of the 225 shares of the first section of the Tokyo Stock Exchange that composites the Nikkei. Population mean formula. The population mean, or this, is the arithmetic mean value of the population for the infinite population. The population mean is this. So you add all of them together and then divide by the number of the observed sample, or the observed population, where n is the number of observation in the entire population and xi is the if, or the digit to number I of the observation. The population mean is an example of a parameter. The population mean is unique. That is, given population has only one mean. To illustrate the calculation, we could take the case of the population mean to profit as a percentage of revenues of the U.S. companies running major wholesale clubs for 2012. During the year, profit as a percentage of revenue for BJ's Wholesale Club, Costco, Warehouse Corporation, and Walmart stores was 0.9%. 1.6% and 3.5% respectively, according to the Fortune's 500 list for 2012. Thus, the population mean. The population mean profits as a percentage of revenue was U equals 0.9 plus 1.6 plus 3.5 divided by 3, which is 6 divided by 3, which is 2%. So that is the population mean. Now, what is the sample mean? The sample mean is an arithmetic mean computed by from a sample. Many times we cannot observe every member of a set. Instead, we observe a subset or a sample of the population. The concept of the mean can be applied to the observation in a sample with a slight change in notion. Sample mean formula. The sample mean on average, or X bar, is the arithmetic mean value of a sample. So it's this formula where n is the number of observations in the sample. Okay, so instead of using the whole population, we just use the sample of the population. It's really simple. So equation 3 tells us to sum the values of the observation of xi and divide the sum by the number of observations. For example, if a sample of price to earnings, the PE, the PE ratio is if the multiple of 6 publicly traded companies contains a value of 35, 30, 22, 18, and 15, and 12, and the PE and the means of PE is 132 divided by 6 equals 22. The sample mean is also called the arithmetic average. As we discussed earlier, the sample mean is a statistics that is a descriptive measure of a sample. Means can be computed for individual units or over time. For instance, the sample might be the 2013 return on equity, the ROE, for the 100 companies in the FTSE Euro Top 100, the index of Europe's 100 largest companies. In this case, we calculate the mean ROE in 2013 as an average across the 100 individual units. When we examine the characteristics of some units at the specific point in time, such as ROE for the FTSE Euro Top 100, we are examining cross-sectional data. The means of that observation is called a cross-sectional means. On the other hand, if our sample consists of the historical monthly return on the first FTSE Euro Top 100 for the past 5 years, then we have time series data. The mean of these observations is called time series mean. We will examine specialized statistical model related to the behavior of time series in the reading on time series analysis. Next, we show an example of finding the sample mean return for 16 European equity markets for 2012. In this case, the mean is cross-sectional because we are averaging individual country returns. Example 3, calculating a cross-sectional mean. The MSCI EAFE, the Europe, Australasia, and Far East Index of the Free Float Adjusted Market Capitalization Index, designed to measure developed market equity performance for excluding the United States and Canada. As of September 2013, the EAFE consists of 22 developed markets indexes, including index of 16 European markets, 2 Australasian markets, Australia, New Zealand, 3 Far Eastern markets, Hong Kong, Japan, and Singapore, and Israel. Suppose we are interested in the local currency performance of the 16 European markets in the EAFE. In 2012, we want to find a sample mean total return of the 2012 across the 16 markets. The return series reported in Table 8 are the local currencies because this return is not stated in any single investor's home country. It's not a return any single investor would earn. Rather, it's the average of the returns of the local currency of the 16 markets. So here's the average return. Using the data in Table 8, calculate the sample means return of the 16 equity markets in 2012. So by doing that, you'll get around 11.68%. So just by adding them up and dividing by the number of the samples. Example 3, we can verify that the 8 markets had returns less than the mean, and 8 had holdings returns that were greater. We should not expect any of the actual observations to equal the means because sample means provide only a summary of the data being analyzed. Also, although in this example the number of values below the means is equal to the number of values above the means, needs not be the case. As an analyst, you will often need to find a few numbers that describe the characteristics of the distribution. The mean is generally the statistic that you will use to measure performance of 2 different markets. For example, you may be interested in comparing the stock market performance of investment in Pacific Rim countries with investment of European countries. You could use the mean return in the markets to compare investment returns. 5.1.3 properties of arithmetic means. The arithmetic mean can be likened to center of gravity of an object. Figure 5 expresses the analogy graphically by plotting 9 hypothetical observations on a bar. The 9 observations are 2, 4, 4, 6, 10, 10, 12, 12, and 12. The arithmetic mean is the frequency. The arithmetic mean is 72 divided by 8 divided by 9, which gives us 80 observations are plotted on the bar of various highlights based on their placed on the factorum. Its balances only when the factorum is located at the point of the scale that corresponds to the arithmetic mean. So this balances out when there are 8 9s out of the 72. As analysts, we often use the means return as a measure of the typical outcome for an asset. As in the example above, however, some are above the means of some are below it. We could calculate the distance between the means of each other. Each outcome and call in a deviation. Mathematically, it is always true that the sum of the deviation around the mean equation 0. We can use this by using the definition of the arithmetic means and showing equation 3, multiplying both sides of the equation. Nx bar equals sigma n to sigma I to n to n, I to 1 to n to x to the power of 1. Yeah, so it's this formula. Deviations from the arithmetic mean are important information because they indicate risk. The concept of deviation around the mean forms the foundation for the more complex concepts of variance, skewness, and kurtosis, that of which we'll discuss later in this reading. An advantage of arithmetic mean over 2 other measures of central tendency, the medium and mode, is that mean used in the information about the size of the magnitude of the observation. The mean is also easy to work with mathematically, a property and distribution and a property and potential drawback of the arithmetic mean is its sensitivity to extreme values because all observations are used to compute the mean. The arithmetic mean can be pulled sharply upwards or downwards by extremely large or small observations respectively. For example, suppose we are to compute arithmetic mean of the following 7 numbers, 1, 2, 3, 4, 5, 6, and 1,000. The arithmetic mean is 1,200 10,021 divided by 7, which is 145.6 point 87, or approximately 146, because the magnitude of the mean 146 is so much larger than that of the bulk. The observation, the first 6, we might question how well it is as a financial data set. May only represent a rare value in the population. It may also form a different population from the producing of other observations in a sample. We discussed the median next. The median, a second important measure of central tendency, is the median. Definition of the median. The median is the value of the middle item of a set of items that has been sorted into ascending or descending order in an odd and even number sample. In an odd number sample of n times, the median occupies the n plus 1 divided by 2 position. In an even numbered sample, we define the median as the means of the value of the item occupying n divided by 2, or n plus 2 position divided by 2% in the two middle terms. Earlier, we gave the profit as a percentage of revenues of 3 wholesale clubs, 0.9, 1.6, and 3.5, with an odd number of observation n equals 3. The median occupies of the n plus 1 divided by 2 is 4 divided by 2, which is the second position. The median was 1.6 because it was in the middle. It was the second position. The value of 1.6 is the middlemost observation. One lies above it, one lies below it. Whether we use the calculation for an even or odd number sample, an equation number or observations lies above or below the median. A distribution has only one median, not affected it. Only extreme values do not affect it. The median, however, does not use all the information about the size and magnitude of the observation and focuses only on the relative position of the ranked observation. Calculating the median is also more complex to do so. We need to order the observation from smallest to largest, determine whether the sample size is even or odd, and on the basis apply 1 or 2 calculations. Mathematicians express this advantage by saying that the median is less mathematically tractable than the mean in Table 9 in ascending order of the 2012 final return of European equities, because array that occupies the 16 divided by 2 is 8th, and 18 divided by 2 is 9th. Finland's returns occupies the 8th position of the return at 8.27%, and Sweden's return occupies the return of 87.27 plus 12.66 divided by 2, which is around 10%. Note that the median is not influenced by extreme large or extreme small outcomes. Had Spain's total return be much lower values, or Belgium's total return be much higher values, the median will not have changed using a context that arises often in practice. Example 4 shows how to use the means and a median in a sample with extreme values. So here's Table 9, the total returns of European equity markets by a country in 2012. Example 4, medium and arithmetic means the case for the price earnings ratio. Suppose a client asks you for valuation analysis on 7 stock U.S. common stock portfolios given a Table 10. The stocks are equally weighted in the portfolio. One valuation measures that you can use the PE ratio to shape the earnings, and examining the PE definition is defined as current price divided by the current means of all analysts. EPS estimates for the company for the fiscal year 2013. Consensus current EPS is the table. The value of Table 10 are as the 9th of September 9th, 2013, September 9th, 2002. That's a terrible day for New York City. For compare, hey day Delilah, how are things in New York City? I'm 1,000 miles away, but girl, tonight you look so pretty. Yes, you do. I need to get back to CFA. Oh, yes, I do. For comparison purposes, the average oh my gosh, I'm so sorry for just singing on random. Okay. Table 10 shows the P/E ratio for client portfolios, the consensus current, and the consensus PE. Using the data in Table 10, address the following. Calculate the arithmetic mean PE, calculate the median PE. So the median is just the middle. So it would most likely be this. The mean will be adding them all up and dividing it by 7. Solution to 1, the mean of PE is 13.15 plus 10.97 plus 12.15. Hold on, I have to get the door. Somebody's at the door. Solution to 1, the mean of PE is 13. Alright, there was nobody at the door. That was just my roommate. Anyways, the mean of PE is 13.15 plus this. Just add them all up, divided by 7. That's the mean. And the median would be when we put them all in ascending order, and then we look at who's at the middle. Okay. Solution to 3. Okay, so what is 3? 3 wants us to evaluate the means and median of the PE and measure the central tendency for the above portfolio. So which one will be more appropriate? Let's look at what the solution has to say. Quick Technology's PE of approximately 205 tremendously influences the value of the portfolio's arithmetic means of the PE ratio. The mean PE is about 42. Is much larger than a PE of 6 of the 7 stocks of the portfolio. The mean PE also misleading, suggestive orientation to stocks with high PEs. The means of the PE of the stock, excluding the click technologies or excluding the largest and smallest PE stocks, click technologies, and the Ford Motor companies, is below the average PE of 18.8. For the companies of the S&P 500 index, the median PE of 13.94 appears to be better representative of the central tendency of the PEs. It frequently happens that when a company's EPS is quite low, at the low point in the business cycle, for example, its PE extremely high. The lower the P, the usually better it is. Okay, the high PE in these circumstances reflects an anticipated future recovery of earnings. Extreme PE values need to be investigated and handled with care for reasons related to this example. The analysts often use the median price of the multiple to characterize the valuation of the industry group. 5.3, the mode. The third important measure of central tendency is the mode. Definition of the mode. The mode is the most frequently occurring value in a distribution. A distribution can have more than one mode or not even one mode. When a distribution has one most frequently occurring value, the distribution is said to be a unimodal. If a distribution has two most frequently occurring values, then it has two modes, and we say it is bimodal. If the distribution has 3 most frequently occurring values, then it is trimodal. When all the values in the data set are different, the distribution has no mode, but no value occurs more frequently than any other value. Stock return data and other data from continuous distribution may not have a model outcome. When such data are grouped into intervals, however, we often find an interval, possibly more than one. With the highest frequency, the mode interval or intervals. For example, the frequency of distribution for the monthly returns of the S&P 500 has a model interval of 0% to 2%. As shown in Figure 2, this return interval has 220 observations out of the total 1,044. The model interval always has the higher bar, or the highest bar in the histogram. The mode is one measure of the central tendency we can use with nominal data. So there are two types of data, nominal and continuous, and nominal data is most appropriate. Okay, when we categorize mutual funds into different styles and assign a number to each style, the mode of these categorized data is the most frequent mutual fund style. 5.4 other concepts of means. Earlier, we explained that arithmetic mean, which is the fundamental concept of describing the central tendency of data. Other concepts of means are very important in the investments. In the following, we discuss such concept. Example 5, calculating a mode. Table 11 gives the credit rating of a senior unsecured debt as September 2002 of 9 U.S. department stores rated by Moody's Investors Service in descending order by credit quality. Increasing expected probability of default. Moody's ratings are AAA, AA1, AA2, blah, 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 all the way to C18, which is the worst. Senior unsecured debt rating, U.S. Department stores, September 2013. So these are the department stores and these are the credit ratings. Using the data in Table 11, address the following concerning the senior unsecured debt of the U.S. department store. State the model credit rating. Say the median credit rating. Okay. A solution to 1. So the median is just the average, and the model is what the heck is the model? I don't know what the model is. That's so weird. Okay, solution to 1. So what is the model credit rating? The group of companies represented 6 distinct credit ratings are ranging from BAA1 to CAA1. To make our task easy, we first organize the ratings into a frequency distribution of this. Okay, so the frequency distribution. Credit ratings BAA1, BA2, and B3 has the frequency of 2, and the other 3 has the frequency ratings of 1. Therefore, the credit rating of U.S. department stores in September 2013 is tri-model, which means 3 of them are the most common. Okay. Where BAA1, BA2, and B3 being the 3 models. Moody's considers bonds rates BAA to be moderate credit risk, BA to be a substantial credit risk, and B to be a high credit risk. Solution for 2, for the group n equals 9, the odd number, the group's median occupies the n plus 1 divided by 2, which is 10 divided by 2, which is the 5th position. We see from table 12 that BA2 occupies the 5th position. Therefore, the median credit rating as September 2013 was BA2, the rated means. The concept of weighted mean arises repeatedly in portfolio analysis. In the arithmetic means, all observations are equally weighted by the factor 1 divided by n, or 1 divided by n is working with portfolios. We need the more general concept and weighted means to allow different weights on different observations. To illustrate the weighted mean concept, an investment manager with 10 million investment may allocate 70 million to equities and 30 million to bonds. The portfolio has a weight of 0.7 on stocks and 0.3 on bonds. How do we calculate the return on the portfolio? The portfolio's return clearly involves an average of the return on the stock and bond investment. The means that we compute, however, must reflect the fact that the stock has a 70% weight in the portfolio and bonds have a 30% weight. The way to reflect this weighting is to multiply the returns on the stock investment by 0.7 and the returns on the bond investment by 0.3, then sum the two results. The sum is an example of weighted means. It would be incorrect to take the arithmetic mean of the return on the stock and bond investment, equally weighing the returns on the two asset classes. Consider a portfolio invested in Canadian stocks and bonds. The stock component of the portfolio includes RBC, Royal Bank of Canada, RBC, Canadian index funds, which track the performance of the S&P divided by /TSX. composite total return index, the bond composite of the portfolio issued by Canadian governments and corporations. The portfolio manager allocates 60% of the portfolio to Canadian stocks and 40% to Canadian bond funds. Table 13 presents total returns for these funds from 2008 to 2012, returns for Canadian equity and bond funds between 2008 and 2012. There we go. Weighted mean formula, or the weighted mean, we mean X, red X bar sub W, with a set of observation X sub 1, X sub 2 to X sub N, with the corresponding weight W sub 1, W sub 2, W sub N is computed as this. Where the sum of the weighted equals is 1, and the summation of sum I to W sub I is 1. In the context of the portfolio, positive weight represents an asset held long, and negative weight represents the asset held short. The return on a portfolio under consideration is a weighted average of the return of the Canadian stock fund and Canadian bond fund. The weight of the stock fund of 0.6, that the bond fund is 0.4. We find using equation 4 that portfolio returns for 2008 is negative 19.9%. Damn, that's a bad year. Well, 2008 is the recession, so that's not too shocking. It should be clear that the correct mean to compute it in this example is the weighted mean and not the arithmetic mean. If we have computed the arithmetic mean for 2008, we will have calculated returns equals of that, of negative 16.6. Given the portfolio manager invested 60% of its stock and 40% of its bond, the arithmetic mean would underweight the investment in stocks and overweight the investment in bonds. Bonds are more stable, so therefore the negative return is lesser if we allocate 50-50 instead. Okay, so that's why. So we have to look at the allocation of the portfolio in order to calculate the risk as well. Now suppose that the portfolio manager maintains a constant weight of 60% in stocks and 40% in bonds for 5 years. The method is called the constant proportions strategy because value is price multiplied by quantity. Price fluctuation causes portfolio weights to change. As a result, the constant proportion strategy requires rebalancing to restore the weight of stocks and bonds to their target levels, assuming that the portfolio manager is able to accomplish the necessary rebalancing. We could compute the portfolio returns of 2009, 2010, 2011, and 2012 with equation 4 as follows. Portfolio returns of 2009 is equal to 0.6, around 24.9%. And as you could see, these are the portfolio returns for 2009, 10, 11, 12. We can now find the time series means for the returns between 2008 and 2012 using the equation 3. For the arithmetic means, the time series means of the total portfolio is around 4.2%. Instead of calculating the portfolio time series means returns to the portfolio annual returns, we could calculate the arithmetic mean stocks and bonds fund returns for the 5 years and then apply the portfolio weights of 0.6 and 0.4 respectively to these values. The mean stock fund return of around 3%. Therefore, the mean total return of the portfolio is 4.2%, which agrees to our previous calculations. Example 6, portfolio returns as a weighted means in Table 14. Table 14 gives information on the asset allocation of the pension plan for the Canadian Broadcasting Corporation in 2012, as well as the returns on these assets classes in 2012. Asset allocation for the pension plan for the Canadian Broadcasting Corporation in 2012. Here's the asset allocation weight of percentage, I assume. Yes, in percentage, I think. And here's the asset class return. So, solution converting the percentage asset allocation to decimal form. We find the means return as the weighted average of the asset class returns. We have this, which gives us a total of around 8% return. The previous example illustrates the general principles of the portfolio returns in a weighted sum. Specifically, a portfolio's return is the weighted average of the returns on the assets in the portfolio. The weight applies to each asset return in the fraction of the portfolio invested in the assets. Market indexes are computed as weighted averages. The market capitalization index is such that the CAC 40 in France, or the TOPIX in Japan, and the S&P 500 in the United States, each includes stock receive a weight corresponding to its outstanding market value divided by the total number of values of all the stocks in the index. Our illustration of weighted means use past data, but they might just as well use forward-looking data. When we take a weighted average for a forward-looking data, the weighted means is called the expected value. Suppose we make one forecast for the year-end level of the S&P 500, assuming economic expansion, and other forecasts for the year's end of S&P 500, assuming economic contraction. If we multiply the first forecast by the probability of expansion and the second forecast by the probability of contraction, and then add the weights of forecast, we calculate the expected value of the S&P 500 at the end year. If we take the weighted average of the possible future returns of the S&P 500, we are computing the S&P 500's expected return. The probability must sum to 1, satisfying the condition of the weighted and expression of the weighted means as in equation 4. The geometric mean. The geometric mean is the most frequently used in the average rates of returns, or the average rate of change over time, or to compute the growth rates of a variable. In investments, we frequently use the geometric mean to average a time series of rates of returns on an asset or portfolio, or to compute the growth rate of a financial variable such as earnings or sales. In this reading, on the time value of money, for instance, we computed a sales growth rate. Example 17, the growth rate was a geometric mean because of the subject's importance. The later sections we will return to the geometric mean and offer proportional perspective to its use. The geometric mean is defined by the following formula. The geometric mean formula, the geometric mean G is the step observation of x1, x2 to the xn, x sub n. Equation 5 has the solution of the geometric mean to exist. Only the product under the radical signs of is non-negative. We impose the restrictions that all the observations of xi in equation 5 are greater or equal to 0. We can solve for the geometric mean by using equation 5 directly when with any calculating devices such as a calculator that has exponentiary exponentiation key, or most calculators of y to the power of x. So yeah, the geometric mean. When we have computed ln(g), or the ln g, then g equals e to the ln g. On most calculators, the key for is to e to the power of x. Risky assets have a negative return of up to negative 100%. If the price falls to 0, we must take the same care in defining the relevant variable to average and computing the geometric means. We cannot just use the product of the returns for the sample and then take the nth root, because the returns of any period can't be negative. We must redefine the returns of the market to be positive. We do by adding 1 to the returns expression as a decimal. The term 1 plus r sub t represents the year-end value relative to the initial unit of investments at the beginning of the year. As long as we use 1 plus sub rt, r sub t, the observation would never be negative, because the biggest negative return is negative 100%, right? You can't lose more than 100% of your portfolio. The result is a geometric mean of 1 plus r sub t. Then by subtracting 1 from the result, we obtain the geometric mean of the individual r sub t. For example, the returns of the RBC Canadian Index Fund during the 2008 to 2012 period was given table 13 as negative 0.331, 0.341, 0.168, 0.09, negative 0.092, and 0.064, putting them at the returns of the decimal form. Adding 1 to these returns produces 0.6691 and blah blah blah, which gives us 1.002455, which is around 2%. No, 2.4%, 2.5%. Okay, so this is a geometric mean formula, and
we could use equation 7, which is equation 6, was the geometric mean formula to solve for the geometric mean return for any return data series. Geometric mean returns are also referred to as the compound rate, or the compound return. If the returns are being averaged on equation 6, we have a monthly frequency. For example, we can call the geometric means monthly returns by compounding monthly returns. The next example illustrates the computation of the geometric means while the contrasting geometric and arithmetic mean. Example 7, geometric and arithmetic mean returns 1. As a mutual fund analyst, you are examining, as of early 2013, the most recent 5 years of total returns of the U.S. large cap value equity mutual funds. So here's the selective American shares. Here is the price equity income. Based on the data in table 15, address the following. 1, calculate the geometric mean returns of the SLASX. Calculate the arithmetic means. And so this is just a sample question. You could just look at it yourself. This is also just a sample. Are they talking about anything new? The harmonic mean. Okay, let's talk a little bit about the harmonic mean. So this is just a sample. We're not going to be going into that. And the harmonic mean is something else. The arithmetic mean, the weighted mean, and geometric mean are the most frequently used concept in the means investments. The fourth concept, the harmonic mean, or the H bar sub the X bar sub H, is appropriate in a limited number of applications. So the H bar sub the X bar sub H is the harmonic mean formula. The harmonic mean formula uses the observation of X sub 2, X sub 1, X sub 2, all the way to X sub n is given by this. The harmonic mean is the value obtained by summing the reciprocals of the observations, terms of the formula 1 divided by r x sub I, then averaging the sum by dividing the number of observations n, and finally taking the reciprocal of the average. The harmonic mean may be viewed as the special type of weighted means in which an observation's weight is inversely proportional to the magnitude. The harmonic mean is a relatively specialized concept of the mean that is appropriate when averaging ratios per unit amount per unit when the ratios are repeatedly applied to a fixed quantity or yield a variable number of units. The concept is best explained through an illustration. A well-known application arises in an investment strategy known as cost averaging, which involves periodic investments of a fixed amount of money in its applications. So this is what harmonic means. So that is part 5 of the reading 8 of the CFA Level 1 program curriculum. This is a long series, and I'll see you guys in the next section, reading 1, part 6 for the other measures of location and the quartiles. Hope to see you guys there, and have a good one. Goodbye. Continued reading of the CFA Level 1 program curriculum, reading 8, part 6, other measures of location. We have quantiles. Having discussed measures of central tendency, we now examine an approach to describe the location of data that investors identify values or below which specified proportions of the data lies. For example, establishing that 25, 50, and 75% of the annual return on a portfolio are at or below the value of 0.05, 0.16, and 0.25 respectively provides concise information about the distribution of portfolio returns. Statisticians use the words quantile or factile as the most general term for a value at or below which the stated fraction of data lies. In the following, we describe the most commonly and used quartiles, quantiles, quartiles, quintiles, and deciles and percentiles, and their application in investment. 6.1 quartiles, quintiles, deciles, and percentiles. We know that the median divides the distribution in half. We can define other dividing lines as the split distribution into smaller sizes. Quartiles divide the distribution into quarters. quintiles into fifths, deciles into tenths, and percentiles into hundredths. Given a set of observation, the y percentile is the value at or below which y% of the observation lies. Percentiles are used frequently, and the other measurements can be defined with respect to them. For example, the first quartile, Q1, divides the distribution such that 25% of observations lie at or behind it. Therefore, the first quartile is at the 25th percentile. The second quartile, Q2, represents the 5th percentile, and the third quartile, Q3, represents the 75th percentile, because 75% of the observations lie at or below it. When dealing with actual data, we often find that we need to approximate the value of a percentile. For example, if we are interested in the value of the 75th percentile, we may find that no observation divides the sample such that exactly 25% of the observations lie at or below the value. The following procedures, however, can help us determine or estimate a percentile. That procedures involves first locating the position of the percentile with the set of observations, and then determining or estimating the value associated with that position. Let P sub y be the value at or below which y percentile of the distribution lies. And the y percentile, for example, P 18th, is the point at or below which 18% of other observations lie. 100 minus 18 equals 82% and are greater than P18. The formula for the position of percentile is the array with n entries sorted in ascending order is L sub y is equal to L sub y is equal to n plus 1 multiplied by n, y divided by 100. It's 100 because we have percentiles. And percentiles are percentages, which is out of 100. Where y is the percentage point at which we are dividing the distributions of L sub y, is the location of L of the percentiles. P sub y is the array sorted in ascending order. The value of Ly may or may not be the whole number. Okay. As an example of the case of Ly is not a whole number, suppose that we want to determine the third quartile of returns for 2012 Q3 or P 75 for the 16 European equity markets given in table 8. According to equation 8, the position of the third quartile is L 75 is equal to 16 plus 1 multiplied by 75 divided by 100. 12.75, or between the 12th and 13th item in the table 9, which ordered the returns in ascending order. The 12th item on table 9 is the return to equity in France in 2012, 15.9%. The 13th item in returns to equity in Austria is in 2012 is 20.72%. Reflecting the 75, 0.75 in 12.75, we will conclude that P75 lies 75% of the distance between 15.9 and 20.72%. To summarize, when the location of Ly is a whole number, the location corresponds to an actual observation. For example, if Denmark had not been included in the sample, then n plus 1 would have been 16, and L75 would equal to 12. The third quartile would be P sub 75 is equal to X12, where X is defined as the value of observations in the IF. I is equal to L equals 25 position of the data sorted in ascending order.
So when L sub y is not a whole number or an integer, Ly lies between the two closest integer numbers, one above and one below. And when we use linear interpolation between these two places to determine P sub y, interpolation means estimating an unknown value based on two known values that surrounds it. So, but in the case, it will look like this. The nearest whole numbers below and above Ly establishes the position of the observation of the brackets P sub y and the interpolation between the values of those two numbers observed. Example 9 illustrates the calculation of various quantiles for the dividend yield on of the component of a major European equity index. Example 9, calculating percentiles, quartiles, and quintiles. The Euro STOXX 50 is an index of 50 publicly traded companies, which provides a blue chip representation of the super sector index for the Eurozone. Table 17 shows the market capitalization on 15 component stocks in the index as provided by STOXX Limited in September 2013. The market capitalization are ranked in ascending order. So here's the market capitalizations in billions of euros. Here's the company, and here's its ranking from smallest to largest. Okay, so 1, 2, 3, 4, 5, 6, 7, 8, 9 goes all the way down to 50. So these are the 50 top traded companies in the Euro STOXX 50. Okay, so let's do some calculations. Using the data in table 17, address the following. Calculate the 10th and 90th percentile. Calculate the first, second, and third quarters. State the minimum say the value of the medium. How many quantiles are there? And what is the percentile? Do the quantiles correspond? Calculate the value of the first quintile. Okay. Solution to 1. So what's one calculating? It is calculating the 10th percentile and the 90th percentile. So in this example, n equals 50. What is n? N is the amount of companies. So n equals 50. You can, using equation 8, Ly equals n plus 1 divided by multiplied by y divided by 100 for positions of the y percentile. So for the 100 percentile, we have 50 plus 1, because we have 50 companies plus 1, multiplied by 10, divided by 100, 10, because y is 10 for the 10th percentile, which is equal to 5.1. So the 10th, L10, or the 10th percentile, is between the 5th and 6th observation of values F5, which is 12.884, and L6, which is 13.60. So we have to, it's already in ascending order, so we just have to look at the 5th and the 6th between Rapso and Saint Gobain. I don't know what kind of language that is. I just speak Spanish and English and Chinese, so I don't know what that is. Anyways, for the 90th percentile is also really similar. Instead of having the 10%, we have a 90%, and all the rest is the same, as around 45.9. So that gives us 45.9. So we look at 45.9, which is here. So either 50 and 60, 50.93, and 51.17. So yeah, so we add them. Yeah, so we put them together and we get this. Solution to 2, what is 2 asking? 2 is asking to calculate the first, second, third quartiles. That's easy. We just calculate it. Instead of putting it into the 100th percentile, we just put it into a quarters. So out of 25. So the 25 out of 100, and we just look at that as the same thing. Solution to 3 is also the same thing. 4 is also the same thing. 5 is also the same thing. Just know this formula. This formula, and you would be fine for knowing the quartiles, the quantiles, the percentiles, and stuff. Okay, 6.2, quantiles in investment practices. In this section, we discuss the use of quantiles in investment. Quantiles are used in portfolio performance evaluation, as well as investment strategy development and research. Investment analysts use quantiles every day to rank performances. For example, the performance of portfolios. This performance of investment managers is often characterized in terms of quantiles in which they fall relative to the performance of their peer group in managers. The Morningstar Mutual Fund star ranking, for example, associates the number of stars with percentiles of performance relative to similar style mutual funds. Another key use of quantiles is in investment research. An analyst refers to a group defined by the particular quantile as the quantile. For example, analysts often refers to set of companies with returns falling between 10th percentile cutoff point as the bottom return decile. Decile is out of 10 or out of 5, I'm not sure. Dividing data into quantiles based on some characteristics allows analysts to evaluate the impact of the characteristic on the quantity of quantity of interest. For instance, empirical finance studies commonly rank companies based on the portfolios of the companies with the smallest market value, and the 10th decile contains those companies with the largest market value. Ranking companies by decile always allows analysts to compare the performance of small companies with large ones. We could illustrate the use of quantiles, in particular quartiles. This is kind of confusing. Quantiles and quartiles look so similar. So we could illustrate the use of quantiles, in particular quartiles, in investment research using the example of Ibston et al. 2013. The study proposed the investment style based on liquidity, buying stocks of less liquid stock, of selling stock of more liquid stock, and it compared the performance of this style with the 3 already popular investment styles, which includes 1 firm size buying stocks of small firms and selling stocks of large firms, 2 value/growth buying stocks of value firms defined as value firms defined as firms with the stock price is relatively low in relation to earnings per share, the PE ratio, book value per share or dividend per share, and selling stocks of given firms defined as firms per share, the dividend per share, and selling stocks of growth firms defined as firms for which the stock price is relatively high in relation to some measures, and a momentum buying stocks of firms with high momentum in return or winners, and selling stocks of firms with low momentum. We could illustrate the use of quantiles, in particular quantiles in investment research using the example of Ibston. We read that already. Ibston et al. Examined the top 3,500 U.S. stocks by market capitalization. For the period of 1971 to 2011, for each stock, they computed yearly measures of liquidity as annual shares turnover, the sum of the 12-month volume divided by each month's shares outstanding, size of the year, and market capitalization value as trailing earnings to price ratio as of the year end. The momentum of the annual return, they assign 1/4 of the total sample for the lowest liquidity in the year of quartile 1, and the 1/4 with the highest liquidity in the years of quartile 4. The stock with the second highest liquidity form quartile 3, and the stock with the second lowest liquidity quartile 2. Treating each quartile group as a portfolio composed of equally weighted stocks, they measure returns of each liquidity quartile in the following year, so that the quartiles are constructed before the fact. The authors repeated this process for each of the other 3 investment styles. Size, value, and momentum. The result from Table 1 of the study are included in Table 18. We have added a column with the spreads in return to quartile 1 to quartile 4. Table 18 reports each investment's style, geometric and arithmetic means returns, and standard deviation of returns for each quartile grouping. And each style moving from quartile 1 to quartile 4 means return decreases. For example, the geometric mean returns for the least liquid stock is 14.5%, and the most liquid stock is 7.24%. Only for the case of size, the standard deviation decrease at each step moving from quartile 1 to quartile 4. Thus, the table provides evidence that the investment style generally having incremental value in explaining returns in relation to standard deviation. The authors conclude that the liquidity appears to differentiate the returns approximately as well as the other styles. Table 18 cross cross-sectional investment style returns percentage, the standard deviation of returns percentage of 1972 to 2011. So there's a lot of data. So we have the geometric mean, the arithmetic mean, the standard deviation for Q1 to Q4, and then for each of them, for the size, for the value, the momentum, and the liquidity, and then how the performance are, and the spread between Q1 and Q4, which is like a summary of all of the changes, the delta. To address the concern of liquidity, may simply be a proxy for the firm size, which investing in less liquid firms, being equivalent to investing in small firms. The authors examine how less liquid stock performed relative to more liquid stock. While controlling a firm size, this step involved constructing equally weighted double-sorted portfolios in firm size and liquidity quartiles. They constructed 16 different liquidity and size portfolios. 4 multiplied by 4 is 16, and investigated the interaction between these two styles. The result from table 2 of their article are included in table 19 and have added columns with the spread of returns in quartile 2 to quartile 4 for each size category. Table 19, a mean annual return of percentage is the standard deviation of returns of percentage of the size of liquidity quartile portfolios of 1972 to 2011. So this is once again the data. The table shows that within the quartiles, with the smallest firms, the lower liquidity portfolio earned an annual geometric mean return of 15.36%, in contrast to the high liquidity portfolio return of 1.32%, producing a liquidity effect of 14.4 percentage point of 1404 basis points. For the liquidity effect is stronger in the smallest firms. It does not persist in the other 3 size quartiles also. The results indicate that size does not capture liquidity, i.e. the liquidity effect holding regardless of size group. Let me see how long chapter 17 is before I start reading chapter 7 as well, or part 7 of chapter 8. Yeah, this is a long chapter. All right, let's start reading chapter 7. I mean, it's a long chapter, but let's just get into it. Who cares? All right, part 7, chapter 8, part 7 of chapter 8, the CFA Level 1 program curriculum, measures of dispersion. As we know, as the well-known researcher Fisher Black has written, the key issue in investments is estimating expected returns. Few would disagree with the importance of expected returns or mean return in investments. The mean return tells us where returns and investments results are centered. To completely understand an investment, however, we also need to know how returns are dispersed around the mean. Dispersion is the variability around a certain tendency, a central tendency. If means returns addresses upwards, dispersion addresses risk. In this section, we examine the most common measures of dispersion: range, mean, absolute deviation, variance, and standard deviation. All of the measures of absolute dispersion. Absolute dispersion is the amount of variability present without comparisons to any reference point or benchmark. These measures are used throughout investment practices. The variance or standard deviation of return is often used as a measure of risk, pioneered by Nobel laureate Harry Markowitz, William Sharpe, another winner of the Nobel Prize in economics. Okay. Developed the Sharpe ratio, a measure of risk adjusted performance that makes use of standard deviation of return. Other measures of dispersion, mean, absolute deviation, and range are also useful in analyzing data. The range, we encountered range. We encountered range earlier when we discussed the construction of frequency distribution. The simplest of all, the measure of dispersion range can be computed with intervals of ratio data. Definition of range. The range is the difference between the maximum and minimum value of a data set. Range equals maximum value subtracted by minimum value. As an illustration of range, the largest monthly return of the S&P 500 in the period of January 1926 to December 2012 is 42.56% in April of 1933, and the smallest is negative 29.73% in September of 1931. The range of return is 72.28 to 9%, or 42.56%. Subtracted by negative 29.73%. An alternative definition of range reports the maximum and minimum values. This alternative definition provides more information than does range as defined in equation 9. One advantage of range is the ease of computation. Disadvantage is that the range is only two pieces of information from the distribution. It cannot tell us how the data is distributed, that is, the shape of the distribution, because the range is the difference between the maximum and minimum returns. It can reflect extremely large or small outcomes that may not be respective of the distribution. 7.2, the mean absolute deviation. Measures of dispersion can be computed using all the observations in the distribution rather than just the highest and lowest. The question is, how should we measure dispersion? Our previous discussion on properties of the arithmetic mean introduced the notion of distance of deviation from the mean, x sub I minus x bar as the fundamental piece of information used in statistics. We can compute measures of dispersion as the arithmetic average of the deviation around the mean, but we will encounter a problem. The deviation around the mean always sums to 0. If we computed the mean of the deviation, the result would be equal to 0. Therefore, we need to find a way to address the problem of negative deviation canceling out the positive deviation. One solution is to examine the absolute deviation around the mean, as in the mean absolute deviation. Mean absolute deviation formula, the mean absolute deviation, or the MAD for sample is mean absolute deviation equals sigma I to the power I to the n to the absolute of x sub 1 sub I subtracted by x bar divided by everything divided by n, where x bar is sample mean and n is the number of observations in the sample. In calculating MAD, or the mean absolute deviation, we ignore the signs of the deviation around the mean. For example, if x sub I is equal to negative 11 and x bar is equal to 4.5, the absolute value of the difference is negative 11 minus 4.5, which equals to negative 15.5, but we don't look at the negative sign, we just look at 15.5. The mean absolute deviation uses all of the observations in the sample and is thus superior to the range as a measure of dispersion. One technical drawback of MAD, or the mean absolute deviation, is the formula is it is difficult to manipulate mathematically compared to the next measures. We will introduce variance. Example 10 illustrates the use of range and the mean absolute deviation to evaluating risk. Example 10, the range and mean of absolute deviation. Having calculated the mean returns of the two mutual fund in example 7, the analyst is now concerned with evaluating risk. So here is the year, here's the selected American shares and how they do, and here is the price equity index. Based on the data in table 15 on the previous page, which is this page, right? Table 15. Is this table 15? It's table 19. Okay, well, I don't want to go all the way back to 15 though. Oh, this is table 15. Okay. So this is table 15. So based on the data in table 15 on the previous page, answer the following questions. Calculate the range of annual returns of SLASX and B PRFD 2, calculate the mean absolute deviation of returns on A, SLASX, and B, PRFDX, and shares, and state whether the mutual fund appears to be riskier based on MAD. Solution to 1 for SLASX, the largest return was 31.64%, and the smallest was negative 39.44%. The range is therefore 71.08%. For PFRDX, the range was negative, was 25.62, added, because subtracted, which gives us added by 35.75%, which gives us 61.37%, with a larger range of returns than the PRFDX. The SLASX appears to be riskier fund, appears to be the riskier fund during the 2008 to 2012 period. Solution to 2, you literally just bring it in and get the results. You literally just bring it in and get the results. Okay, and you compare the two results to see which one is more risky. 7.3, population variance and population standard deviation. The mean absolute deviation addresses the issue that the sum of deviation from the mean equals 0 by taking the absolute value of the deviation. Second approach to the treatment of deviation is to square them. The variance and standard deviation will be based. So remember, in standard deviation, how standard deviation is the square root of variance. So if you multiply standard deviation by itself, you get variance. So just know that. A variance is defined as the average for the spread deviation around the mean. Standard deviation is the positive square root of the variance. So that's literally just what I was talking about. The following discussion addresses the calculation of the use of variance and standard deviation. 7.3.1, population variance. If we know every member of the population, we could compute the population variance, denoted by the symbol 2. The population variance is the arithmetic average of the squared deviation around the mean. Population variance formula, the population variance is this, where mu is the population mean and n is the size of the population. Given knowledge of the population mean, mu, we can use equation 11 to calculate the sum of the squared difference for the mean, taking account for all n items in the population, and then to find the mean squared difference by dividing the sum by n. Whether a difference from the mean is positive or negative, squaring that difference results in a positive number. That's why we square root a variance to get standard deviation. Thus, variance takes care of the problem of negative deviation from the mean, canceling out the positive deviation by operation of squaring those deviations. The profit as a percentage of revenue of BJ's Wholesale Club, Costco, and Walmart are given earlier as 0.9, 1.6, and 3.5 respectively. We calculate the means profit of the percentage of revenue as 2.0. Therefore, the population variance of the profit of the percentage of revenue is a third, because it represents a third. Each company represents a third because we have 3 companies. A third multiplied by this, which gives us 1.21. 7.3.2, population standard deviation. Because the variance is measured in squared units, we measure a way to return to the original units. We can solve this problem by using standard deviation. The square root of the variance, standard deviation, is more easily interpreted by the variance because standard deviation is expressed at the same unit of measurement as observations. Population standard deviation formula. The population standard deviation defined as the positive square root of the population variance. So literally just the variance formula, but with a square root around it. The mu sign right here is the population. Mean of n is the sign of the population. Using the example of the profit as the percentage of revenue for BJ's Wholesale Club, Costco, and Walmart, according to equation 12, we could calculate the variance 1.21, then take the square root of 1.21 equals 1.10. Both the population variance and standard deviation are examples of parameters of distribution. In a later reading, we will introduce the notion of
variance and standard deviation as risk measures. In investments, we often do not know the mean of a population of interest, usually because we cannot particularly identify or take measurements from each member of the population. We then estimate the population mean with the means from a sample drawn from the population, and we calculate a sample variance or standard deviation in subsequent sections. However, in investments, we sometimes have a defined group that we can consider to be a population. With well-defined populations, we use equation 11 and 12 as in the following example. Example 11, calculating population standard deviation. If you use a better calculator, if the CFA allows us to use a better calculator, we won't have to memorize these. We can literally just plot them in. For example, I used a TI Inspire for my high school and college years, and I got to just do standard deviation by itself. No need to memorize the formula. But too bad CFA doesn't let us use better calculators. Calculating the population standard deviation. Table 20 gives the yearly portfolio turnover of 12 U.S. equity funds. The composites, the 2013 Forbes magazine honor roll portfolio turnover, a measure of trading activity, as the lesser of the value of sales of purchasing over a year divided by the average net asset during the year. The number of identities of the fund. And the Forbes honor rolls charge over the last year, over year to year. Table 12, that's what it shows. Based on the data in Table 12, address the following. Calculate the population mean portfolio turnover of periods used by Forbes for the 12 honor rolls funds. Calculate the population variance. So if you have the variance and you have the standard deviation, and if you have the means, you literally just plug it into the formula. 7.4, the sample variance and sample standard deviation. In the following discussion, notes switch to Roman letters to symbolize sample quantities. 7.4 is the sample variance. In many instances in investment management, a subset of samples of population is all that we can observe. When we deal with samples, the summary measures are called statistics. The statistics that measures the dispersion is in a sample is called the sample variance. Sample variance formula, the sample variance is this, where X bar is the sample mean and N is the number of observation in the sample. Example, equation 13 tells us to take the following steps to compute the sample variance. Calculate the sample mean of X bar. Calculate each observation's square deviation from the sample mean of X sub I subtracted by X bar to the power of 2. Sum the squared deviation from the mean of this. Divide the sum of the squared deviation from the mean by this. We will illustrate the calculation of sample variance and the sample standard deviation. In example 12, we use the notion S squared for the sample variance to distinguish it from the population variance of O2. The formula for sample variance is nearly the same as for population variance, except for the use of sample mean, or X bar, in place of population mean, which is mu, at a different divisor. In the case of the population variance, we divide by the size of the population N. For the sample variance, however, we divide by the sample size minus 1 or N minus 1 by using N minus 1 rather than N as a divisor. We improve the statistical probabilities that the sample variance in statistical terms. The sample variance defined as equation 13 is an unbiased estimator of the population variance. The quantity N minus 1 is also known as the number of degrees of freedom in estimating the population variance. To estimate the population variance with S to the power of 2, we must first calculate the mean. Once we have computed the sample mean, there are only N minus 1 independent deviations from it. 7.4.2 sample standard deviation. Just as we computed a population standard deviation, we can compute the sample standard deviation by taking the positive square root of the sample variance. sample standard deviation formula. A sample standard deviation S is S equals this, which is the variance to the power to the power of 1/2, or the square root, where x bar is the sample means and n is the number of observations of the sample. To calculate the sample standard deviation, we first compute the standard variance using the steps given. We then take the square root of the sample variance. Example 12 illustrates the calculation of the sample variance and standard deviation of two mutual funds introduced earlier. Calculating sample variance and standard deviation. After calculating the geometric and arithmetic means returns of two mutual funds in example 7, we calculate two measures of dispersion for those funds. The range and mean absolute deviation of return in example 10. We now calculate the sample variance and sample standard deviation of returns for those same two funds. So these are the funds. Based on the data in table 15 repeated above, answer the following. Calculate the sample variance of returns for A, SLASX, B, PRFDX. Calculate sample standard deviation of returns for A, SLAX, X, and B, PRFDX. Contrast the dispersion of returns as measured by standard deviation of returns and the mean absolute deviation of returns of each of the two funds. Solution to 1. Calculate the sample variance. We use equation 13. Deviation answers are all given in percentage squared, or percent squared. The sample mean is all of these added together, divided by 4, which is 2.68. The square deviation for the measures are this. The sum of the square deviations this. So these are just literary calculations. You can pause the video and look at it if you have questions. Solution to 2, literally just bring it in. Solution to 3, we analyze it. Table 1221 summarizes the results of part 2 for standard deviation and incorporates the results of the MAD for example 10. Note that the mean absolute deviation is less than the standard deviation. The mean absolute deviation will always be less than or equal to the standard deviation, because the standard deviation gives more weight to large deviations than small ones. Remember that deviations are squared. Because the standard deviation is a measure of dispersion about the arithmetic mean, we usually present the arithmetic mean and standard deviation together with summarizing data. When we are dealing with data that represents a time series of percentage change, presenting the geometric mean representing the compound rate of growth is also very helpful. Table 22 presents the historical geometric and arithmetic mean returns along with the historical standard deviation of return for S&P 500 annual and monthly return series. We present these statistics for nominal rather than inflation-adjusted returns, so we can observe the original magnitude of the returns. Equity market returns, means and standard deviation. Returns series, the monthly and annual returns, geometric, arithmetic, standard deviation. 7.5, semi-variance, semi-deviation, and related concepts. Quite a heavy chapter as well. An asset's variance or standard deviation of return is often interpreted as a measure of the asset's risk. Variance and standard deviation of return often accounts for returns above or below the means, but investors are concerned only with downside risk. For example, risk below the means. As a result, analysts have developed semi-variance, semi-deviation, and related dispersion measures that focuses on downside risk. Semi-variance is defined as the average squared deviation below the mean. Semi-variance is sometimes called the semi-standard deviation. Is the positive square root of semi-variance. To compute the sample semi-variance, for example, we take the following steps. Calculate the sample mean, identify the observations that are smaller than or equal to the mean, discarding observations greater than the mean. Compute the sum of the squared negative deviation from the mean using the observations that are smaller or equal to the mean. Divide the sum of the square negative deviation from step 3 by the total sample size minus 1. Comma, not comma. Oh, what are these two dots called? I don't know. I forgot what my punctuation is called. Yeah. Formula for semivariance approximating the unbiased estimator is this. The x sub 1 is lesser or equal to the x bar summation of x sub 1 minus x bar to the squared divided by x minus 1 to take the case of selected American shares with returns in percent of negative 39.44, 31.64, 12.53, negative 4.35, and a 12.82. We earlier calculated a mean return of 2.64%. Two returns, negative 39.44 and negative 4.35, are smaller than 2.64. We computed the sum of the squared negative deviation from the means of this. This is the means. With n minus 1 equals 4, we conclude that semivariance is 454.9, and the semi-deviation is the square root of that, which is around 21.3%, approximately. The semi-deviation of 21.3% is less than the standard deviation of 26.7% from the downside risk perspective. Therefore, standard deviation outstates risk. In practice, we may be concerned with values of return or another variable below some levels other than a mean. For example, if our return objective is 12.75% annually, we may be concerned particularly with returns below 12.75% a year. We could call 12.75% a target. The name target semivariance has been given to average square deviation below a stated target. The target semi-deviation is its positive square root. To calculate a sample target semi-variance, we specified the targets as a first step. After identifying observations below the target, we find the sum of the squared variance deviation from the target and divide the sum by the number of the observation minus 1. A formula for the target semivariance is summation of x sub 1 is lesser than equal to b, which which is when x to the power x sub 1 minus b to the power of 2 divided by the whole thing divided by n minus 1. So which, if we plug it in, will give around 27.5% approximately. When return distributions are symmetrical, semivariance and variance are effectively equivalent. For symmetric distribution, variance and semivariance rank prospects risk differently. Semivariance or semi-deviation and target semivariance or target semi-deviation has an intuitive appeal, but they have harder to work with mathematically than variance. Variance or standard deviation enters into the definition of many of the most commonly used financial risk concepts, such as the Sharpe ratio and beta. Perhaps because of the reasons variance or standard deviation is much more frequently used in investment practices. The Chebyshev's inequality. I hope I'm reading this right. I have never seen this word before. I'm literally also reading this the first time with you guys. The Russian, you see how many more pages left. Seven pages. The Russian mathematician Nazi Chebyshev developed an inequality using standard deviation as a measure of dispersion. The inequality gives the proportion of values within K standard deviation of the mean. Definition of Chebyshev's inequality: according to Chebyshev's inequality, for any distribution within finite variance, the proportions of the observation within K standard deviations of the arithmetic mean is at least 1 minus 1 divided by K squared for all K greater than 1. Table 23 illustrates the proportion of observations that must lie within a certain number of standard deviation around the sample mean. So K, what is K? K is the standard deviation of the arithmetic mean. And this is the proportion. When K is 1.25, for example, the inequality states that the minimum proportion of the observation that lies within 1.25s is 1 minus 1 divided by 1.25 to the squared. 1 minus 0.64 equals 0.36 or 36%. The most frequently cited fact that results from Chebyshev's inequality are that a 2 standard deviation interval around the mean must contain at least 75% of the observation, and a 3 standard deviation interval around the mean must contain at least 89% of the observations, no matter how the data are distributed. The importance of Chebyshev's inequality stems from its generality. The inequality holds the samples and population from the discrete and continuous data regardless of the shape of the distribution. As we shall see in the readings on sampling, we can make much more precise interval statements if we can assume that the sample is drawn from a population that follows a specific distribution called the nominal distribution. So we have the discrete and we have the nominal distribution. So I will see what this means later. Frequently, however, we cannot confidently assume that distributions for next example illustrates the use of Chebyshev's inequality. Applying Chebyshev's inequality according to table 22, the arithmetic mean, monthly return, and standard deviation of monthly returns on the S&P 500 was 0.94% and 5.5% respectively during the 1926 to 2012 period, totaling 1,044 monthly observations. Using this information, address the following. Calculate the endpoints of the intervals that must contain at least 75% of monthly returns according to the Chebyshev's inequality. What are the minimum and maximum number of observations that must lie in the interval computed in pair 1 according to Chebyshev's inequality? A solution to 1. According to Chebyshev's inequality, at least 75% of observations must lie within the 2 standard deviation of the mean, x bar plus 2s. For the monthly S&P 500 return series, we have 0.94%. Plus or minus 2 multiplied by 5.5% is equal to 0.94%, plus or minus 11%. Thus, the lower endpoint of the interval must contain at least 75% of the observations, in 0.9594% subtracted by 11% is equal to 10.06%. And the upper endpoint of 0.94 plus 11% is 11.94. Solution to 2 is also just putting in the number. Seven 7.7 of reading 8, CFA level 1 of the coefficient of variation. We noted earlier that standard deviation is more easily interpreted than variance because standard deviation uses the same unit of measurement as the observation. We may sometimes find it difficult to interpret what standard deviation means in terms of variance degree or variability of different sets of data. However, either because of the data set has markedly different means or because the data set has the different unit of measurement. In this section, we explain a measure of relative dispersion, the coefficient of variance that can be useful in such situations. Relative dispersion is the amount of dispersion relative to reference value or benchmark. We can illustrate the problem of interpolating a standard deviation of data set from the markedly different means using 2 hypothetical samples of companies. The first sample composed of small companies, included companies with 2003 shares of 50 million, 75 million, and 65 million, and 90 million. The second sample composed of large companies, includes companies with 2003 shares of 800 million, 825 million, 815 million, and 840 million. We could verify using equation 14 that the standard deviation 90 million is 80 is an 80th percent larger than the smallest observation, 15 million. In the second sample, the largest observation is only 5% larger than the smallest observation. Informally, a standard deviation of 16.8 million represents a high degree of variability, reflective relative to the first sample. We reflect the mean 2003 sales of 70 million euro by the small degree of variability relative to the second sample, which reflects mean of 2003 sales of 820 million. The coefficient of variance is helpful in situations such as that just described. Coefficient variance formula: the coefficient variance, or the CV, is the ratio of the standard deviation of a set of observation to the mean value. CV, or the coefficient variation, is S divided by X bar. S is the sample standard deviation. X bar is the sample mean. When the observations are returns, or for example, the coefficient of variance measures the amount of risk standard deviation per unit of means returns, expressing the magnitude of variance among observations relative to their average size. The coefficient of variation permits direct comparison of dispersion across different data sets, reflecting the correction of scale. The coefficient of variance is a scale-free measure. That is, it has no unit of measurement. When we illustrate the application of coefficient of variation using our earlier example of two samples of companies, the coefficient of variation for the first sample is 16.8 million and divided by 70 million, which is 0.24. The coefficient of variance of the second sample is 16.8 million or divided by 820 million, which is 0.02. This confirms the intuition that the first sample had much greater variability in cells than the second sample. Note that 0.25 and 0.02 are pure numbers in the sense that they are free of units of measurement, because we divide the standard deviation by the mean, which is measured in the same unit as the standard deviation. If we need to compare the dispersion among data sets stated in different units of measurement, the coefficient of variance can be useful because of it is free from the use of measurements. Example 14 illustrates this, a calculation of the coefficient of variance. Example 14, calculating the coefficient variation. So there's just calculations, there's nothing to see there. 7.8, the Sharpe ratio. Although CVs were designed as a measure of relative dispersion, its inverse reveals something about the return per unit risk, because the standard deviation of returns is commonly used as a measure of investment risk. For example, a portfolio with a mean monthly return of 1.19% and a standard deviation of 4.42% has inverse CV of 1.19% or divided by 4.42%, which is 0.27. The result indicates that each unit of standard deviation presents 0.27% return. A move precise return risk measures recognizes the existence of risk-free returns. A return of virtually zero standard deviation when a risk-free asset or an investment or can choose a risky portfolio P and the combo and then combines the portfolio with risk-free assets to achieve the desired level of absolute risk at measured by standard deviation of returns S sub P. Consider a graph of which with mean returns of the vertical axis, standard deviation of the returns on the horizontal axis. Any combination of portfolio X and the risk-free assets lies on the ray of the outlines axis, and any combination of portfolio P and the risk-free asset dividend by S sub P, the ray given investors choices offering the most rewards, return in excess to risk-free trade rates the per unit risk for which one with the highest shape, the ratio by excess returns of standard deviation, the returns of portfolio P, the slope of the rays, and the Sharpe ratio after its developer. William F. Sharpe.
Sharpe ratio formula. The Sharpe ratio for the probability P based on historical returns is defined as SH is equal to R bar P subtracted by R bar F divided by SP, where R P is the mean returns of the portfolio. R bar F is the mean return in an risk-free asset, and SP is the standard deviation of returns on a portfolio. The number of the Sharpe measures in the portfolio is means returns minus the mean return on the risk-free asset over the same period. The R bar P minus R bar F terms measures the extra reward that investors receive for the added risk taken. We call this difference the mean excess return on portfolio P. Thus, the Sharpe ratio measures the reward in terms of mean excess return per unit of risk as measured by standard deviation of returns. Those risk-averse investors who make decisions only in terms of mean returns and standard deviation of returns prefer portfolios with larger Sharpe ratios to those with smaller ratios. Okay, so here's an illustration. The conceptual limitation of Sharpe ratio is that it considers only one aspect of risk, standard deviation of return. Standard deviation is most appropriate as a risk measure for portfolio strategies with approximately symmetrical returns distribution, strategies with options elements with symmetrical returns. Relatedly, an investment strategy may produce frequent small gains but have potential for infrequent but extremely large losses. Such a strategy is sometimes described as picking up a coin in front of a bulldozer, for example. Some hedge fund strategies tend to produce a return pattern calculated over, example 15 illustrates the point. And that's part 7 of reading 8 of the CFA Level 1 program curriculum. I hope to see you guys in the next section where we'll be talking about symmetry and skewedness in return distribution. I hope to see you guys there, and take it easy. Goodbye. Alright, welcome back. CFA Level 1 program curriculum reading 8, part 8. Symmetry and skewedness in return distributions. Mean and variance may not adequately describe an investment distribution of returns. In calculation of variance, for example, the deviation around the mean are squared. So we do not know whether large deviations are likely to be positive or negative. We need to go beyond measures of central tendency and dispersions to reveal other important characteristics of the distribution. One important characteristic of interest to analysts is the degree of symmetry in return distribution. If a return distribution is symmetrical about its mean, then each side of the distribution is a mirror image of the other image. Thus, equal loss and gain intervals exhibit the same frequency. Losses from -5% to -3%, for example, occur when about the same frequency as gains from 3% to 5%. One of the most important distributions is the normal distribution, depicted in Figure 6. The symmetrical bell-shaped distribution plays a central role in the mean variance model of portfolio selection. It is also used extensively in financial risk management. The normal distribution has the following characteristics. 1, its means and median are equal. 2, it's completely described by two parameters, its mean and variance. 3, roughly 68% of its observation lies between plus and minus 1 standard deviation from the mean. 95% lies between the plus and minus 2 standard deviations, and 99% lies between plus and minus 3 standard deviation. If you guys have taken statistics in college or university, you would know a standard deviation. You would know the 68, 95, and 99% rule. Distribution that is not symmetrical is called skewed. A return distribution with positive skewed has frequent small losses and few extreme gains. So this is skewed to the positive side because it has more extreme gains. A return distribution with negative skew has frequency small gains and a few extreme losses. Figure 7 shows a continuous positively and negatively skewed distribution. The continuous positively skewed distribution shows shown has a long tail on its right side, and the negative skewed distribution has a long tail on its left side. The positively skewed has a long tail at its right side, and the negatively skewed has a tail at its left side. For the continuously positive skewed unimodal distribution, the model is less than the mode is less than the median, which is less than the mean. For the continuously negatively skewed unimodal distribution, the mean is less than the median, which is less than the mode. Investors should be attracted by a positively skewed because the mean returns falls above the median relative to the mean return. Positive skewed amounts to a limited through frequent downside compared with a somewhat unlimited but less frequent upside. So this is the standard deviation probability of 68% is between 1 and -1 standard deviation. 95 is between 2 and -2, and 99% is between 3 and -3. So yeah, this is the 95. This is the 99 percentile. So if you calculate standard deviation, if it has the distribution of a standard deviation, then it should look something like this. So this is what we call nominal distribution. So nominal PDF, and we have nominal CDF if you want to calculate the area. You don't really need to use calculus to calculate the area. I know a lot of people, including me, hate calculus, but yes, you could calculate as using your calculators. Okay. Figure 7, properties of skewness distribution. So this one shows a positively skewed. So it's skewed to the left, therefore more tail. The right tail is longer, therefore that's a positively skewed. And this one right here is negatively skewed because the tail at the right hand side, the tail at the left hand side is longer than where the mean is. Okay, skewness is the name given to a statistical measure of skew. The word skewness is also sometimes used interchangeably for skew. Like variance skewness is computed using each observation's deviation from its means. Skewness is sometimes referred to its relative skewness is computed as the average cubed deviation from the mean standardized by dividing the standard deviation cubed to make the measure free of scale. A symmetrical distribution has skewness of 0. A positively skewed distribution has a positive skewness, and a negatively skewed distribution has a negative skewness as given by its measure. We can illustrate the principle behind the measure by focusing on the numerator. Cubing, unlike squaring, preserves the sign of the deviation from the mean. If a distribution is positively skewed with a mean greater than its median, then more than half of the deviation from the mean are negative and less than half are positive. In order for the sum to be positive, the losses may be small and likely to gain, less likely to be small and likely, and the gains less likely to be more extreme. Therefore, if skewness is positive, the average magnitude of positive deviation is larger than the average magnitude of negative deviation. A simple example illustrates that a symmetrical distribution has a skewness measure equal to 0. Suppose we have the following data: 1, 2, 3, 4, 5, 6, 7, 8, 9. The mean outcome is 5. The deviation is -4. -3, -2, -1, 0, 1, 2, 3, 4, and 4. Cubing the deviation yields, we get these, and with the sum of 0. Because if we add all of them up, they get 0, because it's a perfectly skewed one. Yes, it's perfectly skewed. So at number 5, we have both 4 numbers greater and 4 numbers smaller. So if we add them all together, we get 0. The numerator of skewness and the skewness itself is equal to 0. Supporting our claim below, we give a formula for computing skewness from a sample. Damn, that's a nasty equation. Okay. Here's the skewness formula, the sample skewness, also called the relative skewness. When n is the number of observations in a sample, and s is the sample standard deviation. The algebraic sign of equation 17 indicates the direction of skewedness, with a negative sk indicating a negatively skewed distribution and a positively sk indicating a positively skewed distribution. Note that as n becomes larger, the expression reduces to the mean cube deviation. Sq equals this as a frame of reference from a sample size of 100 or larger taken from the normal distribution. A skewness coefficient of negative minus 0.5 will be considered unusually large. Table 27 shows several summary statistics for the annual and monthly returns on the S&P 500. Earlier, we discussed the arithmetic means return and standard deviation of return, and we shall shortly discuss kurtosis. Okay. So here's the table, S&P 500 annual and monthly total returns between 1929 and 2012. So here's the periods a month, the monthly and the annual returns. Arithmetic mean, the standard deviation is skewedness. So it's slightly negatively skewed and slightly positively skewed. Kurtosis. Okay. Table 27 reveals the S&P annual return during the period was negatively skewed, while monthly returns are positively skewed, and the magnitude of skewedness was greater in the annual series. We would find for other market series that the shape of the distribution of returns is often dependent on the holding period examined. Some researchers believe that investors should prefer a positive skewedness, all else equal. That is, they should prefer portfolios with distribution offering relatively large frequencies of unusually large payoffs. So it's less stable, but when payoffs do occur, the payoffs are much larger. So that's what some investors believe. Other different investment strategies may tend to introduce different types of amount of skewness into returns. So the more negatively skewed it is, the lesser the frequency, the greater the frequency, but the smaller the payoffs. And the opposite is true when it is negative. Okay. Example 16 illustrates the calculation of skewedness for a managed portfolio. Example 16, calculating skewedness for a mutual fund. Table 28 presents 10 years of annual returns on T, a row price equity income fund, the year and the percentage returns. Yeah, you see the trend of 2008. 2008 is a terrible year for most people. Okay. Using the information in Table 8, address the following. Calculate the skewedness of PRFDX, showing two decimal places. Characterize the shape of the distribution of PRFDX returns based on your answer in Part 1. Solution to 1, calculate the skewedness. We find a sum of the cube deviation from the mean divide by the standard deviation cubed, and then multiply the results by n divided by n minus 1 multiplied by n minus 2. Given table 29 gives the calculations. So yeah, these are the calculations, and the skewedness is negative 1.84. Okay, so literally you just have to remember the formula, know how to calculate it using your calculator, and get the answers. Okay, using equation 17, the calculation is this. Solution to 2. Based on the small sample, the distribution of annual returns for a fund appears to be negatively skewed. In this example, 4 deviations are negative and 6 are positive. While there are more positive deviations, there are much more than offset by the huge negative deviation in 2008. When the stock market sharply went down as a consequence of the global financial crisis, the result is the skewedness is a negative number, implying that the distributions is skewed to the left. Kurtosis in returns distribution. Kurtosis in return distributions. In the previous section, we discussed how to determine whether a return distribution deviates from the normal distribution because of skewedness. On the other way, one other way in which a return distribution might differ from a normal distribution is its relative tendency to generate large deviation from the mean. Most investors would perceive a greater chance of extremely large deviations from the mean as increasing risk. Kurtosis is a measure of the combined weight of the tail of the distribution relative to the rest of the distribution. That is the proportion of the total probability that is in the tail. a distribution has a fatter tail than the normal distribution is called a leptokurtic. A distribution that has a thinner tail than the normal distribution is called a platykurtic. And a distribution identical to the normal distribution concerns relative weight are called the mesokurtic. A lepokurtic distribution tends to generate more frequent extremely large deviations from the means and the normal distribution. Figure 8 illustrates a leptokurtic distribution. It has fatter tails than the normal distribution. By constructing a leptokurtic and normal distribution have the same mean, standard deviation, skewness. Note that the leptokurtic distribution is more likely to be normal distribution to generate observations in the tail region defined by the intersection of graph near a standard deviation of about negative or minus 2.5. The leptokurtic distribution is also more likely to generate observations that are near the mean, defined here as the region plus or minus 1. Standard deviation around the mean is compensation to have probability sum to 1. The leptokurtic distribution generates fewer observations in the region between the central region and the two tail regions. Okay, so the solid line is the normal distribution. The fat tail distribution. So what's the fat tail distribution? That's the fat tail distribution. And the fat tail distribution would be the leptokurtic. Yes. To calculate for kurtosis involves finding the average of the deviations from the mean raised to the 4th power. So when they raise to the 4th power, then you are no longer also keeping the positive or negative signs. The positive and negative signs get ignored when we raise it to the 4th power. And then standardizing the average by dividing by the standard deviation raised to the 4th power. So both gets raised to the 4th power. For all normal distributions, kurtosis is equal to 3. Many statistical packages report estimates of excess kurtosis, which is kurtosis minus 3. Excess kurtosis thus characterizes kurtosis relative to the normal distribution, or normal or other mesokurtic distribution has excess kurtosis equal to 0. A leptokurtic distribution has excess kurtosis greater than 0. And a platykurtic distribution has excess kurtosis less than 0. A return distribution with positive excess kurtosis, a leptokurtic return distribution, has more frequent extremely large deviations from the mean than the normal distribution. Below is the expression for computing kurtosis from a sample. Sample excess kurtosis formula. The sample excess kurtosis is this monstrosity of a formula. Man, imagine memorizing that. Yeah, we'll when we go over review after I finish the reading of these 3,000 pages, we'll go over the review. Okay. Well, where n is the sample size and s is the sample standard deviation. In equation 18, sample kurtosis is the first term. Note that as n becomes larger, example 18 approximately equals this minus all of this minus 3 for a sample of 100 or larger taken from a normal distribution. A sample excess kurtosis of 1.0 or larger will be considered unusually large. Most equity return series have been found by the leptokurtic. If a return distribution has positive excess kurtosis or leptokurtosis, and we use statistical models that do not account for the fatter tails, we will underestimate the likelihood of very bad or very good outcomes. For example, the returns on the S&P 500 for 19th of October 1987 was 20 good outcomes was a standard deviation away from the mean daily return. Such an outcome, if possible, with a normal distribution, but its likelihood is almost equal to 0. If daily returns are down or drown from a normal distribution, a return for standard deviation or more away from the mean is expected once every 50 years. A return greater than 5 standard deviations always is expected once every 7,000 years. The return for October 8, 1987 is more likely to have came from the distribution that had fatter tails than from a normal distribution. Looking at table 27 given earlier, the monthly return series for the S&P 500 has very large axis kurtosis, approximately 9.4. It is extremely fat tail relatively to the normal distribution. By contrast, the annual return series has about no axis kurtosis. The results for axis kurtosis in the table are consistent with research findings, and the nominal distribution is a better approximation for U.S. equity returns for annual holding periods than for shorter ones. As for monthly. The following example illustrates the calculations for sample axis kurtosis for one of the two mutual funds we have been examining. Calculating sample axis kurtosis, having calculated example 16 and the annual return on T. Raw price equity income fund were negatively skewed during the 2003 to 2012 period. What can we say about the kurtosis of the fund's return distribution? Table 28, repeated below, recaps the annual rates of the fund. So here's the annual rates of returns for T row A price equity between 2003 and 2003 and 2012. Okay. Using the information from table 28 repeated above, address the following. One, calculated sample axis kurtosis of PRFDX showing two decimal places. Characterize the shape of the distribution of the PRFDX returns based on your answer to part 1 as leptokurtic, mesokurtic, and pathykurtic. Solution to 1, calculate axis kurtosis. We find a sum of deviation from the mean raised to the 4th power divided by standard deviation raised to the 4th power, and to multiply the results by n. This calculation determines kurtosis. Extra axis kurtosis is kurtosis minus this. Table 30 gives the calculations. Literally, you just list all of them out. That's some nasty calculations. I absolutely hate this calculation. So axis kurtosis is around 4.09. Using equation 18, the calculation is kurtosis is equal to 4.89. Solution to 2, the distribution of PRFDX annual return appears to be leptokurtic based on the positive positive axis kurtosis. The fairly large axis kurtosis of 4.09 indicates that the distribution of PRFDX's annual return is a flat tail relatively to the normal distribution with a negatively skewedness, and the positive axis kurtosis PRFDX's annual return do not appear to have been nominally distributed during the period. Okay. Part 10, Reading 8, Level 1 CFA Program Curriculum Reading. Alright, Level 1, Reading 8. About quantitative methods, Part 10. Using geometric and arithmetic means with the concepts of descriptive statistics in hand, we will see why the geometric mean is appropriate for making investment statements about past performance. We will also explore why the arithmetic mean is appropriate for making investment statements in a forward-looking context. For reporting historical returns, the geometric mean has considerable appeal because it is the rate of growth or return we would have had to earn each year to match the actual cumulative investment performance. In our simplified example 8, for instance, we purchased a stock of 100 euros, and 2 years later it was worth 100 euros. With the intervening year at 200, the geometric mean of 0% is clearly a compound rate of growth during the 2 years. Specifically, the ending amount of is the beginning amount times this, the 1 plus r sub g to the power of 2. The geometric mean is an excellent measure of past performance. Example 8 illustrates how the arithmetic mean can distort our assessment of historical performance. In that example, the total performance for the 2-year period was unambiguously 0%, with a 100% return for the first year and a negative 50% in the second year. However, the arithmetic mean was 25%, as we noted previously. the arithmetic mean is always greater than or equal to the geometric mean. If we want to estimate the average return over a 1 period horizon, we should use the arithmetic mean, because the arithmetic mean is the average of 1 period returns. If we want to estimate the average return over more than 1 period, however, we should use the geometric means of return, because the geometric means captures the total return are linked over time. As corollary to using the geometric means for performance reporting, the use of semi-logarithmic rather than arithmetic scales is more appropriate when graphing past performances. In the context of reporting performance, a semi-logarithmic, okay, try saying that word, semi-logarithmic, there we go. A semi-logarithmic graph has an arithmetic scale on the horizon axis of time and logarithmic scale on the vertical axis for the value of the investment. The vertical axis values are spaced according to the differences between the logarithms. Suppose we want to represent 1 pound, 10 pound, 100 pounds, and 1,000 pounds as values of an investment on the vertical axis. Note that each successive value represents 10-fold increases over the previous value, and each will be equally spaced on the vertical axis because of the difference in the logarithmic is roughly 2.3. That is, when 10 minus ln 10 minus ln 1 equals ln 100 minus ln 10 equals ln 1000 minus ln 10, which equals 2.3. On a semi-logarithmic scale, equal movements on vertical axis refers equal percentage changes. The growth on a constant compound rate plots the straight line. A plot curving upwards reflects the increasing growth rate over time. The slope of the plot at different points may be compared in order to judge relative growth rates. In addition to reporting historical performance, financial analysts used to calculate expected equity risk premiums in a forward-looking context. For this purpose, the arithmetic means is appropriate. We can illustrate the use of arithmetic means in a forward-looking context with an example based on an investment's future cash flow and contrasting the geometric and arithmetic mean. For discussing future cash flows, the essential issue concerns uncertainty. Suppose an investor with 100,000 faces an equal chance of a 10% return or a negative 50% return, represented on a tree diagram of a 50-50 chance of 100% return and negative 50% return per period, with 100% return in the one period and negative 50% in the other. Geometric means returns of this is equal to 0. So 50% chance you will become 200,000, but also 50% chance you would get deducted by 50,000 points. So the best case scenario is you double your money twice. The worst case scenario is you lose your money twice. You cut your money in half twice. The geometric... I'm literally just drinking honey water now, if you're curious. Honey water, I was about to do tea, but I realized I don't have ice cubes. But then, so I don't want to drink hot tea with honey water. So now it's just cold water with honey in it. Anyways, so the geometric mean returns of 0% gives the model or median of ending wealth after 2 periods, and thus accurately predicts the model or median ending wealth of 100,000 in this example. Nevertheless, the arithmetic mean return better predicts the arithmetic mean ending wealth with equal chances of 100% or negative 50% returns. Consider the 4 equally likely outcomes of 400,000, 100,000, 100,000, and 250,000. As if they actually occurred, the arithmetic mean ending with wealth could be this, because you add them all together and divide by 4, which is the average return you're supposed to get. The actual rate would be 300%, 00%, and negative 75% for a 2-period arithmetic mean return of 56.25%. The arithmetic mean return predicts the arithmetic mean ending wealth of 100,000 multiplied by 1.5625, which equals $156,255. Noting that 56.25% of for 2 periods is 25% per period, we then must discount the expected terminal wealth of that at the 25% arithmetic mean rate to reflect the uncertainty in the cash flow. Uncertainty in cash flow or returns causes the arithmetic mean to be larger than the geometric mean. The more uncertain the returns, the more the divergence exists between the arithmetic and geometric means. Okay, the geometric means return approximately equals the arithmetic return minus half of the variance of returns. Zero variance or zero uncertainty in returns will leave the geometric and arithmetic returns approximately equal. But real-world uncertainty presents an arithmetic mean return larger than the geometric. For example, for the nominal annual return on S&P 500 from 1929 to 2012, table 27 reports an arithmetic mean of 11.82% and standard deviation of 20.18%. 20.18%. The geometric means of the returns is 9.84%. We could see the geometric mean is approximately the arithmetic means minus half of the variance of return, which is 9.78%. All right, here's the summary. What is the summary of CFA Level 1, Chapter 8? Well, in this reading, we have presented descriptive statistics, the set of methods that permits us to convert raw data into successful information for investment analysis. That's what quantitative analysis is all about. So quantitative analysis is all about taking raw statistics and making sense of it. A population is defined as all members of a specific group. A sample is a subset of the population. A parameter is any descriptive measure of a population. A sample statistic. A statistic, for short, is a quantity computed from or used to describe a sample. Okay, data measurement data measurements are taken using one of four major scales: nominal, ordinal, interval, and ratio. Nominal scales categorize data not by but do not rank them. Ordinal scales sort data into categories that are ordered with respect to some characteristics. Interval scales provide not only ranking but also assurance that the difference between the scale values are equal. Ratio scales have all the characteristics of interval scales, as well as true 0 points as the origin. The scale on which the data measure determines the types of analysis that can be performed on the data. A frequency distribution is the tabular display of data summarized into a relatively small number of intervals. Frequency distribution permits us to evaluate how data are distributed. The relative frequency of observations in an interval is the number of observations in the interval divided by the total number of observations. The cumulative relative frequency accumulates, aka adds up the relative frequency as we move from the first interval to the last, thus giving the fractions of the observations that are less than the upper limit of each interval. A histogram is a bar chart of data that have been grouped into a frequency distribution. A frequency polygon is a graph of frequency distribution obtained by drawing straight lines joining successive points representing the class frequencies. Sample statistics such as measures of central tendency, measures of dispersion, skewness, and kurtosis helps with an investment analysis, particularly in making probabilistic statements about returns. Measures of central tendency specify where data are centered and include the arithmetic mean, median, and mode, most frequently occurring values. The mean is the sum of the observations divided by the number of observations. The median is the value of the middle item, or the middle values of the two middle items, or the mean of the values of the two middle items. So if it's an odd number, then you just get the middle. If it's an even number, then you get two middle numbers. You add them up and divide by 2. Where item is set and sorted into ascending or descending order. The means is the most frequently used measure of central tendency. The median is not influenced by extreme values and is most useful in the case of skewed distributions. The mode is the only measure of central tendency that can be used with nominal data. Portfolio's return is a weighted mean return computed from the returns on the individual assets, where the weight applied to each asset's returns is the fraction of the portfolio invested in the asset. The geometric means G is of a set of observation is this. which is used by calculating this. The geometric means is especially important in reporting compound growth rates for time series data. Quantiles such as median quartiles, quintiles, deciles, and percentiles are location parameters that divides the distribution into halves, quarters, fifths, tenths, and hundredths respectively. Moreover, dispersion measures such as the variance, standard deviation, and mean absolute deviation, the MAD, describes the variability of outcomes around the arithmetic means. Range is defined as the maximum value minus the minimum value. Range has only a limited scope because it uses information from only two observations. MAD, or the absolute or the mean absolute deviation for a sample, is this, where X bar is the sample mean and N is the number of observations in the sample. The variance is the average of the squared deviations around the mean and the standard deviation in the positive square root of variance, and computing sample variance as squared and sample deviation. The average square deviation is computed using the divisor equal to the sample size minus 1. The semi-variance in the average square deviation below the mean semi-deviation is the positive square root of semi-variance. Target semi-variance is the average square deviation below the target level. Target semi-deviation and the positive square root, all the measure quantifies downside risk. According to Chebyshev's inequality, the proportions of the observation within k standard deviation of the arithmetic mean is less than 1 minus 1 divided by k squared for all k equals 1. Is greater than 1. Chebyshev's inequality permits us to make probabilistic statements about the proportions of observations within various intervals about the mean of any distribution with finite variance. As a result, the Chebyshev's inequality, 2 standard deviation interval around the mean must contain at least 75% of the observations, and the 3 standard deviation intervals of the mean must contain at least 89%. So typically, at the third standard deviation, I should have 99. At the second, I should have 96. But this one is different. No matter how the data are distributed, the coefficient of variance, CV, is the ratio of the standard deviation of a set of observations to their mean value, a scale-free measure of relative dispersion by expressing the magnitude of variation among observations relative to their average size. The CV permits direct comparisons of dispersion across different data sets. The Sharpe ratio for a portfolio P based on historical returns is defined as this, where R bar sub P is the mean return of portfolio, bar R sub F is the mean return of the risk-free and asset, and SP is the standard deviation of returns on the portfolio. Skew describes the degree in which a distribution is not symmetrical about its mean. A return distribution with positive skewness have frequent small losses and a few giant gains. A return distribution with negative skewness has frequent small gains and a few extreme losses. Zero skewness indicates a symmetric distribution of returns. Kurtosis measures combined weight of a tail of a distribution relative to the rest of the distribution. Distributions are characterized in leptokurtic, mesokurtic, and platykurtic according to whether there are relatively more, the same, or less weight in the tail. The calculation of kurtosis involves finding the average of the deviation from the mean raised to the fourth power and standardizing by the average by the standard deviation raised to the fourth power. Excess kurtosis is kurtosis minus 3, the value of kurtosis for all nominal distributions. Here's the references, here's the questions. We'll go on for practice questions and when we actually go over the actual content. So right now, I'm just reading all of the content, and after I finish the whole reading of level 1, I'll go on a chapter by chapter lecture. So each chapter or each subset of a chapter would have, for example, reading 10, reading 9, or not reading 10, part 1, part 2, part 3, or reading 8, for example, will each have their own videos. I'll be going into depth of explanation, but yeah. So that's reading 8. I hope my reading has been helpful. I hope to see you guys in the next video where we'll be doing reading 9, continuing a quantitative analysis, quantitative methods, but going into probability. So I do hope my readings are helpful, and I hope to see you guys in the next one. Goodbye.